right. My name is Chris Campbell. I'm a practicing CPA, and I work with small and mid-sized businesses and individuals that have the pay the least amount of taxes possible while keeping them out of jail. So today I wanted to talk a little bit about business structures and particularly LLC structures. So I had a unique situation here that was presented to me by a client where they had an LLC and they owned the LLC. However, they were in startup mode and they took investor money to get this particular LLC going. And again, it's a true startup as far as what they're doing. It's direct to consumer product based. Normally when folks have this sort of setup where they're taking on investor money, this particular investor money was in the form of convertible note. Normally when you take on that kind of debt, you're in startup mode. Your formation is usually a C Corp. Usually I advise folks when they go and get into a startup, and then especially if they bring on other investors, usually the way to go is a C Corp, because that's what investors like to see. And if the idea is to eventually get more funding as a startup or eventually get that new money that comes in, usually likes to see it in the form of a C Corp. So normally you're in the form of a C Corp. However, in this particular instance, they went against the C Corp and went the route of the LLC, because while they're in the process of building this company, a lot of heavy losses with this particular company. You're starting out, and they wanted to be able to use these losses to offset gains in another business that they're active in. So from that standpoint, it made a lot of sense to be structured that way. But now it presented a dilemma where the investor with the convertible note was looking to get converted into equity. Now, the problem is with an LLC, once you have equity, you now have to split. Normally, bring on someone with equity, you are figuring that, okay, well, now I have to split and I have to record the profits and losses. And now I have to share the profits and losses. However, the client was a little hesitant to do that because, one, the investor wasn't active. And that means that as long as the company is showing a loss, it would restrict how much that they would be able to use to offset these gains in the other business. So I was presented with a question as far as what could be the way to structure it. And in doing a lot of the research for this, I was able to see that you have an LLC that, because when you bring on additional equity partners or other member partners, you automatically become a partnership. Usually with LLCs, they're operated with, but when you have partnerships with LLCs and different members, they're ruled by operating agreements. And from what I'm researching, looking at the different options with these operating agreements, and just came to the conclusion that with these operating agreements, they can be tremendously flexible. So you can structure things so that you can the best of both worlds or many worlds. So just for example, if you don't want to share the profits and losses, but yet you have an investor or partner and you don't want to share the profits and losses, say so in the operating agreement. If there are payouts or draws to be made, and you want to make sure that a particular partner gets their draw before any other profits are divvied out, put that in the partnership agreement. So there's enough of different ways. If you only want them to get paid when there's a liquidity event or some sort of exit, you can put that in the partnership agreement. So there's so many other flexible things you can do. I mean, traditionally I would hear about, as a C Corp, have different classes of shares. I guess you can have different classes from ownerships as well. This video is just to educate you. You can be very flexible. If you want to enter into a partnership with someone or a number of people, you can construct your operating agreement such that you can make for a lot of contingencies based upon what everybody is bringing to the table. So one particular thing in this particular instance, and maybe this is something that you could use if you get a situation where you bring on a partner, but they have only what's called a profits interest, where they only get paid if the company exceeds a certain valuation or a particular liquidity event may happen. And then you can also structure it and add in that you don't want them to share in the profits and losses when you report the tax returns. What I mean by that is that in a partnership, the partnership itself doesn't pay the taxes, the owners do, in proportion to what they own. So for example, if there are, say, 4 partners, a partnership, and you say, okay, in a traditional sense, you each have a 25% share. And if the company or partnership generates or makes or net income of 100,000, each partner would then report the 25,000 on their personal return, and each would pay the taxes personally of that 25K on their return. So, and then the same thing, let's say if there was a $100,000 loss, each will report the loss of 25,000, right? So that's in the traditional sense. You're a partner, we report the net profits and losses. And that's what happens traditionally. Now, you can structure your operating agreement such that if there's a particular partner that should not get a share, you can structure the partnership such that everyone doesn't have to get a share, right? But the exception can be, let's say, if there's a liquidity event or a buyout, that person gets 25%. So if we could say, hey, okay, partner X doesn't really work the day to day. Let's say they've only put in money. There's only going to be 3 partners that'll share the profits and losses. So each partner would report 33% of the profit or loss each year in the tax returns. But then if in an event that there's a liquidity event, then that 4th partner could come in and get their share of the 25%. I'm just using that as an example, but the idea is just opening you up to the fact that you can structure your agreement or your partnership to have variances between who gets paid what, who gets the report. If one person necessarily needs to get paid a certain amount on an exit, so let's say that there's an exit and a particular partner put in maybe more than the other, or someone had a lot more sweat equity, they may get paid out a certain amount out before the percentages, before you get split up based upon the rest of the partners. So that was really just the point of this video, is that you can be quite flexible with your arrangements without necessarily having to go the corporation route where you have different classes of shares and it might get a little more complicated. Now, I will say this, is that if the idea is to eventually get acquired and get bought out, right before you take on that equity, possibly switching over to a corporation, but that might be at the discretion of the investors or the folks putting in the money. But, if you're not going that route and you're just looking to operate, number of things that you can do so that it can work out for you both from the tax standpoint. So that was the perspective that I was coming from. I want to give you an idea, get the creative juices flowing when you're looking to put together partnerships in a way to help you out as far as if you want to take advantage of the losses from the tax standpoint, at least in the beginning. So ways you can be creative with it. All right. So hopefully this was helpful. That's all for now. And if you have any more questions about this topic or any other tax or account related questions, feel free to reach out. I'm happy to help.